Good day everyone. So we are the group 8 and we will report about managing the finance function. Presenter number 1 will be Sheena Marie Dorego. Then presenter number 2 will be Aleja Marie Angelada, followed by our icebreaker. Then presenter number 3 will be Manuel Magdonob. Then presenter number 4 will be Kinsler Kyle Dador, and the report will be concluded by our summary. So, let's get started.
Hey everyone, we, the Group 8, are going to report on managing the finance function. So what is the finance function? The finance function is an important management responsibility that deals with the procurement and administration of funds with a view of achieving the objectives of business. So let's define procurement. Procurement is an acquisition of goods, services, or works from an outside external source. And administration is the activities that relate to running a company. So in this next slide, we can see the finance function and its process flow. So first, we should determine the fund of the requirements. Second, the procurement of the funds. And lastly is the effective and efficient use of funds. Now we're going to tackle on financing daily operations. So the day-to-day operation of the engineering firm will require funds to take care of expenses as they come. Money must be available for the payment of the following: for wages and salaries, second, for rent, third, for taxes, fourth, for power and light, fifth, for marketing expenses, and lastly, for administrative expenses. Next is financing the firm's credit services. It is oftentimes unavoidable for firms to extend credit to customers. If the engineering firm manufactures products, for example, sales terms may vary from cash to 90-day credit extension to customers. Next, financing the purchase of inventory. The maintenance of adequate inventory is crucial to many firms. Raw materials, supplies, and parts that are needed to be in storage so they will be available when needed. This is the flow chart of the firm's finances and cash flow. So first, it will be from the customers. It will go down to the sales. And the sales comprises of the inventory, and the inventory consists of the long-term assets such as the production equipment, the land, the building, and also the supply materials. And these sales can be used for accounts receivables. And from the sales, it can be used as cash. And cash consists of the long-term financing, the account receivables, the marketable securities, and the short-term fund sources. And from the sales to the account receivables, it can also be used for cash. And the cash can be used for taxes, salaries, wages, rent, and insurances, but also it can be used for supply materials. Next are the sources of funds. So the sources of funds consist of cash sales, collection of accounts receivables, loans and credits, sale of assets, ownership contribution, and advances from customers. So next is the short-term sources of funds. Loans and credits may be classified as short-term or long-term. Short-term of funds are those with repayment schedules of less than 12 months, while the long-term sources require more than 12 months. So here are the advantages of short-term credits. So first, it is easy to obtain. Second, it is often less costly. And lastly, it offers flexibility to the borrower. The disadvantages of short-term credits are: it is mature more frequently, it may at times be more costly than long-term debt. So next, here are the supplies of short-term funds. So first, trade creditors, commercial banks, commercial paper houses, finance companies, factors, and lastly is the insurance companies.
Good day, this is Aleja Marie Anglada of BSEC 3A, and now let's tackle the firm's finances and cash flow as part of the topic managing the finance function. So I have here a flow chart starting with the customers, going to the sales, then to the cash, to the inventory, back to the sales. So the sales will go first to the account receivables, then to the cash. So the long-term financing like the long-term debt, common stocks, and retained earnings, along with marketable securities and short-term fund sources like the commercial banks, commercial paper houses, finance companies, factors, and insurance companies can be the source of cash. Then the cash will become the taxes, the salaries, wages, rent, and insurance, and it will be used in supply materials that will go to the inventory. So the long-term assets like the production equipment, land, and buildings will also go to the inventory. So moving on, we have the sources of funds. First, the cash sales. So what is a cash sales? So cash sales are sales in which the payment obligation of the buyer is settled at once. So cash sales are considered to include the following forms of payment: bills, coins, checks, credit cards, and money order. Next is the collection of account receivables. So account receivable or AR is the balance of money due to a firm for goods or services delivered or used but not yet paid for by customers. So accounts receivables are listed on the balance sheets as a current asset. So AR is any amount of money owed by customers for purchase made on credit. Next is the loans and credits. So loans refers to a type of credit vehicle in which a sum of money is lent to another party in exchange for future repayment of the value or principal amount. But credit is generally defined as a contract agreement in which a borrower receives a sum of money or something of value and repays the lender at a later date, generally with interest. So moving on to the sales of assets. So it refers to a business selling some or all of its property. This is frequently done as part of the sale or closing of a business or a merger between two businesses. Next, the ownership contribution. So what is ownership? It is a state, act, or right of owning something. Example, possessing something. So the term may also refer to an organization or group of owners. And lastly, the advances from customers. So advance from customer is a liability account in which is stored all payments from customers for goods or services that have not yet been delivered. Once the related goods or services have been delivered, the amount in this account is shifted to a revenue account. Short-term sources of funds. Loans and credits may be classified as short-term or long-term. Short-term sources of the funds are those with the payment schedules of less than 12 months, while long-term sources require more than 12 months. Trade credit. Trade credit refers to the credit extended by the supplier of goods or services to his or her customer in the normal course of business. It occupies a very important position in short-term financing due to the competition. Accruals. Accrued expenses are those expenses which the company owes to the other, but not yet due and not yet paid the amount. Accruals represent the liability that a firm has to pay for the services or goods it has received. So next that we have is the deferred income. So the deferred income is income received in advance by the firm for supply of goods or services in future period. This income increases the firm's liquidity and constitutes an important source of short-term finance. Next is the commercial banks. Commercial banks are the major source of working capital finance to industries and commerce. Granting loan to business is one of their primary functions. Advantages of short-term credits. Easy to obtain, often less costly, and offers flexibility to the borrower. While the disadvantages of short-term credits are mature more frequently and may at times be more costly than long-term debts. So we have here the supply of short-term funds. First is the trade creditor. So a trade creditor is a supplier who has sent your business goods or supplied it with services who you haven't yet paid. Next is the commercial banks. So the term commercial bank refers to a financial institution that accepts deposits, offers checking account services, makes various loans and offers basic financial products like certificates of deposits, CDs, and saving accounts to individuals and small businesses. So a commercial bank is where most people do their banking. Next, commercial paper houses, commonly used type of unsecured short-term debt instrument issued by corporations, typically used for financing of payroll, accounts payable, and inventories, and also meeting other short-term liabilities. Maturities on commercial paper typically last several days and rarely range longer than 270 days. Finance companies. A finance company is an organization that makes loans to individuals and businesses. Unlike a bank, a finance company does not receive cash deposits from clients, nor does it provide some other services common to banks such as checking accounts. Insurance companies. A company which may be for-profit, non-profit, or government-owned that sells the promise to pay for certain expenses in exchange for a regular fee called a premium. Next, long-term sources of funds. Term loans. A term loan is a loan from a bank for a specific amount that has a specified repayment schedule and either a fixed or floating interest rate. Common stocks. Common stock is a security that represents ownership in a corporation. Holders of common stock elect the board of directors and vote on corporate policies. This form of equity ownership typically yields higher rates of return long-term. Bonds. Bonds are investment securities where an investor lends money to a company or a government for a set period of time in exchange for regular interest payments. And lastly, retained savings. It is the amount of net income left over for the business after it has paid out dividends to its shareholders. Term loans. A term loan is a commercial or industrial loan from a commercial bank commonly used for plant and equipment, working capital debt repayment. Term loans have maturities of 2 to 30 years. A term loan is often appropriate for an established small business with sound financial statements. Also, a term loan may require a substantial down payment to reduce the payment amounts and the total cost of the loan.
But when you touch me when I'm alone, you can hold my hand if no one's home. Do you like it when I'm away? If I went through my body, would you love me the same? I can feel all my bones coming back and I'm craving motion. But I never really learned how to live by yourself. It's a curse and it's growing. You're a pond that I'm an ocean. Oh, all my emotions feels like explosions when you were around. And I found a way to kill the sound. Oh baby, I am awake when I'm without you. I need you here to stay. I broke all my bones that day I found you. Crying at the light, was it something I said to make you feel like you're a burden? And if I could turn it all back, I swear that I would pull you from the tide. And guess there is something and there is nothing. There is nothing in between. And in my eyes there is a tiny dancer watching over me. He's saying she's a lady, and I am just a boy singing she's a lady, and I am just a line without a hook. So good day everyone, I am Manuel Maglunob, and here is the continuation of our report. So long-term sources of funds. It includes common stocks, bonds, and retained earnings. So the sources of long-term finance are those sources from where the funds are raised for a longer period of time, usually more than a year. Long-term financing is required for modernization, expansion, diversification, and development of business operations. So first is the common stocks. So what is a common stocks? So common stocks are shares of ownership in a corporation that afford their holders voting rights. So common stocks gives you part ownership, potential dividend payments, preemptive rights, limited liability, price appreciation, and voting rights. And when the company does well, so do you. However, you risk losing your investment. It means that your money invested in the company will only depends on the company, and you can't do anything the growth of your investment. And here is the formula of common stock. So number of outstanding shares is equal to the number of issued shares minus the treasury stocks. So next is the bonds. So bonds are units of corporate debt issued by companies and securitized as tradable assets. So here is the sequence of bonds. First, bond origination, followed by bond is purchased by an investor, then coupon payments, and company repays the principal. And here is a comparison between the stocks and the bonds. So stocks is an equity instrument carrying ownership interest, while bond is a debt instrument with a promise to pay back the money with interest. And in terms of return, stocks gives you dividend, while bonds gives you interest. And in return guarantee, stocks don't have it, while bonds gives you guaranteed return. And in terms of additional benefits, stocks gives you voting rights in the company, while bonds gives you preferential treatment when bond matures. So next is the retained earnings. So what is a retained earnings? So retained earnings is the amount of net income left over for the business after it has paid out dividends to each shareholders. So here is the retained earnings. So it is a profit accumulated by business but not distributed to shareholders. And it is equal to the net profit. And its formula is revenues minus the expenses. And there are factors in determining the best sources of financing. So there are 5. First is the flexibility. Second is the risk. Third is the income. Fourth is the control. And fifth is the timing. So let's go to flexibility. So flexibility is the ability to manage expenses and make everyday life affordable. It helps employees with budgeting and debt reduction. So flexibility will test your management skills in terms of your daily expenses. So next is the risk. So risk refers to the chance that a company will be affected adversely when a particular source of financing is chosen. So in general, as investment risk rise, investors seek higher returns to compensate themselves for taking such risk. Every saving and investment product has different risk and returns. So meaning the return is proportional to the risk. If the risk is higher, then the return should be higher. So next is the income. So income are money that an individual or business receives in exchange for providing labor, producing goods or services, or through investing capital. And next is the control. So control are the procedures, policies, and means by which an organization monitors and controls the direction, allocation, and usage of its financial resources. So control is related to planning, because if you performed well on the planning stage, then more likely you can control the outcome of your decisions. And lastly, the timing. So timing is the act of moving investment money in or out of a financial market, or switching funds between asset classes based on predictive methods. So one of the example where we apply the principle of timing is in the stock market. Example is the Bitcoin or the cryptocurrencies, where we buy a certain currency in its low price range. Then when it reaches a considerable price where we have an interest, then we will sell it and will gain an interest based on the percentage of our capital. And that's all for my report. Thank you.
Good day, everyone. I am Kinzer Caldador, and this is the continuation of our report. So here we have the objectives of engineering firms, and in general, the objectives of engineering firms are as follows: to make profits for the owners, to satisfy creditors with the repayment of loans plus interest, and to maintain the viability of the firm so that customers will be assured of a continuous supply of products, or employees will be assured of employment, and suppliers will be assured of a market. Next is the indicators of financial health. So here we have balance sheet, also statement of financial position, income statement, and also called statement of operations, and statement of changes in financial position. So risk management and insurance. So the engineer managers, especially those at the top level, are entrusted with function of making profits for the company. This will happen if losses brought by improper management of risk are avoided. So risk is a very important concept that the engineer manager must be familiar with. Risk confront people every day. Companies are exposed to them. Newspapers report on a daily basis the destruction of life and property. Companies that could not cope with losses are forced to shut down. So here we have the meaning of risk. So risk refers to the uncertainty concerning loss or injury. So here engineering firm is faced with a long list of exposure to risk, some of which are as follows. So we have fire, theft, floods, accident. This also includes the non-payment of bills by customers, disability and death, and damage claim from other parties. So we have types of risk. So we have two, the pure and speculative. So when we say pure, it is only a chance of loss, a risk that is only a chance of loss. And when we say speculative, it is either gain or loss. So examples of a pure risk are physical damages like fire, flood, and man-made damages. And examples of a speculative risk are brand risk and product success risk. All speculative risks are made as conscious choices and are not just a result of uncontrollable circumstances. So risk management. Risk management is an organized strategy for protecting and conserving assets and people. The purpose of risk management is to choose intelligently from among all the available methods of dealing with risk in order to secure the economic survival of the firm or the company. So here are the methods of dealing with risk. Risk may be avoided, risk may be retained, hazards may be reduced, losses may be reduced, and last, risk may be shifted. So that's all. Thank you.
So, to conclude our report, here is our summary. So, finance function. So, it is a management responsibility that deals with procurement and administration of funds. So, the finance function process flow. First is the determination of fund requirements, followed by the procurement of funds, and the third is the effective and efficient use of funds. And the purposes of funds are to finance daily operations, to finance the firm's credit services, to finance the purchase of inventory, and to finance the purchase of major assets. And here are the sources of funds. First is the cash sales, then the collection of accounts receivables, the loans and credits, the ownership contribution, and the advances from customers. And there are other sources of funds. There are two. First is the short-term sources of funds and the long-term sources of funds. So in short-term sources of funds, it includes loans and credits, and its advantages is easy to obtain, often less costly, and offer flexibility to the borrower. However, it also has disadvantages, which are mature more frequently and more costly if debts. And the long-term sources of funds includes the term loans, common stocks, bonds, and retained earnings. So its advantages are the stability, the cost of capital, and the fixed rate. And its disadvantages are higher interest rate, greater interest cost, the debt-to-income ratio, slow growth of equity, and the caution. And there are indicators of financial health. So first is the balance sheet, second is the income statement, and third is the statement of changes in financial position. And the risk. So risk refers to the uncertainty concerning loss or injury. So its examples are fire, theft, accident, disability, and the worst is death. However, there are methods in dealing with risk. First is the avoidance, second is the retention, then sharing of risk, then transferring of risk, and loss prevention and reduction. It is the same in life. In every decisions that we make, there is always a risk. And there are methods in dealing with those. But as much as possible, we should never avoid it. Because there are benefits on being a risk taker. Taking risk will eliminate the doubts and the asking of what ifs. And even if we fail, we can just continue with more experience and more knowledge. And those experiences will lead us to success. And some say that in order to succeed, we need to take risk. And that's all for our report. Thank you and God bless.